Venture capital firms, or VCs, work in a similar fashion to angels. However, they usually only come into play when a company is looking for a larger round of financing in exchange for equity in the business. The amount invested can depend on the round, for example, seed, Series A, Series B, etc., and valuation of the company, but can range from thousands to tens of millions of dollars. VC firms can provide valuable expertise, strategic direction, and business connections, in addition to their initial capital investment. VCs often invest in a particular industry that they are knowledgeable about or have previously worked in. It is not uncommon for VCs to take a seat on the company's board to provide direct oversight and ensure the right corporate decisions are made. It is important for you to understand that VCs have a fiduciary duty to their investors in the fund, and they're always looking for strong returns. In fact, some may even only invest in businesses with a $1 billion potential. Brett Barris of IA Capital Group, a venture capital funding organization, describes what his organization looks for when deciding whether or not to invest.
These businesses are growing very rapidly. They don't really qualify for debt financing. They're typically losing money, but their top line is growing at 50 to 100% a year. These businesses are scalable nationwide. They're appealing to us because we can come in and we make an equity investment. We typically hold for 3 to 5 years. We help them grow, we help them continue on their trajectory. We provide them resources. We help them with oversight. We sit on the boards. We help them grow their companies and position themselves for a future liquidity event, which could typically be another funding round. A strategic investor could come in and invest or purchase them.
A venture capital investment isn't typically the best option for most individual small businesses. Most VCs nowadays seek high-growth technology, media, consumer, or enterprise-driven companies that can create large, scalable opportunities with the potential to dominate a particular market. But if you are a company with a broad, mainstream appeal, can create a unique and marketable product or service set, and have a bankable management team on board, then it just might be worth a try. Daniel Todd explains how he successfully grew his business by minimizing risk and building trust with his VCs.
When I closed my first little bit of chunk of money, I really tried to raise as little as I needed to get to my next milestone. So when I raised the first chunk, my milestone was hire a co-founder, get him up to speed on the business, and determine what it is that you could actually build. As soon as I did that, then I had enough proof of concept to go raise another $75,000, and then that helped me get the product out to market, show that I actually had potential partners, prove the distribution model, prove the revenue model, and then that started to lead to me able to raise $250,000. And so all along I've been able to kind of take risk out of the business, prove the different fundamentals until most recently I raised about $400,000. And my hope is, of course, that now I've proven that I can take this to tens of millions of dollars a year, ideally hundreds of millions of dollars a year in revenue, and then I can gain the confidence of VCs.
Don't confuse venture capital and private equity. Remember that both are investing in a company in return for equity ownership of your business, but there are important differences. One way to look at the difference between the two is that VCs typically look to invest in companies that are early to mid-stage in their life cycle. Private equity firms are sometimes looking to take equity of more established, later-stage companies that are on a growth trajectory in which they may be heading towards going public, are in need of management turnover, or simply in need of a turnaround. For example, public company that would be suited better as a private company, like Dell Computer. Many of the largest private equity firms focus on businesses that are in distress and in need of significant change or have assets that are underutilized. They invest in the troubled company if they feel they can turn it around to profitability. Other firms may have a portfolio of funds that each focus on different types of investments. Private equity firms typically define their investment strategy and holding period through their firm's investment charter strategy, which is a game plan to return shareholder value over a specific time horizon. To learn more, check out phub.com, venturebeat.com, and nvca.org. Forbes, Fortune, and the Wall Street Journal also have extensive information on the topic.